Hi everyone, I'm Josh O'Connell and this is episode 6 of Irish Tax Unwrapped. Whether you're a business owner, an investor, or just curious, we break down Ireland's tax code for everyone. Welcome back to the show, listeners, and thanks for the feedback on our last episode. We had a great response about the story of the Carlo builder and the offhand comment he made that sunk his case. If you missed it, we discussed the burden of proof in tax disputes, and it's well worth a listen. In today's podcast, we discuss a very interesting and topical subject, the tax treatment of property transactions and in particular, short-term lettings. A listener emailed us for our thoughts on a recent Irish Times piece on AIB shares and CGT losses. There's plenty to chew over there, so we'll dig into that shortly. And last but not least, we're joined by our usual guests today. They've got plenty of insight and some cracking takes, so it's shaping up to be a good one. Make yourself comfy, pour yourself a glass of Tempranillo. If you don't know what that is, keep listening, and let's get stuck in. Welcome back, Derek and Daphne. So to start, what's new in the world of tax since we last spoke?
Well, Josh, the dominant story internationally is that Trump is back in power, and we're all waiting to see what this might mean for Ireland in 2025 and beyond.
The central bank recently raised concerns about potential risks to the Irish economy under the new Trump administration. What are the concerns and why are they significant?
It's an open secret that Ireland's economy has been heavily reliant on foreign multinationals, particularly US tech and pharma companies. These companies contribute significantly to Ireland's tax revenues, jobs, and overall economic activity. The central bank is concerned that the policy changes proposed by the new US administration could disrupt that delicate balance.
So, what exactly is Uncle Sam up to that's setting off alarm bells in Dublin?
The main issues are President Trump's pledges to reduce corporate tax rates in the US, incentivize industries to repatriate production, and potentially impose tariffs.
For Ireland?
If these policies take hold, they could make the US more attractive for these multinationals, reducing the need for them to base their operations in Ireland. This would directly affect Ireland's tax revenues and employment levels.
How critical are US firms for Ireland's economy?
About 11% of Irish workers are employed by multinationals, and corporate tax receipts, primarily from US firms, have grown nearly sevenfold in the past decade.
So American firms are parking their profits in Ireland rather than bringing them back home, fair enough. But what kind of cash are we actually talking about here? What's flowing through Ireland instead of heading stateside?
Revenue from intellectual property, or IP, located here. These assets generate huge taxable profits, but they're easy to move elsewhere.
So the model used to attract US investment today is very different to the Intel model used in the 80s. Before, Ireland's foreign direct investment strategy focused on attracting large multinational corporations to build physical operations here. Now we focus on providing a safe harbour and low tax rate for multinational companies to locate IP. Instead of factories, we have patent offices, which are easier to pack up and move. So, is this the concern? US companies may go home?
Companies could easily move their IP back to the US, taking a substantial portion of Ireland's corporate tax base with them.
Several political and business figures warn that Ireland must engage with Trump's team now. But in Leinster House, they are fighting over Doyle's seats when the economy could go on fire at any moment. Where is the central bank in all of this?
The central bank has echoed warnings we're hearing elsewhere about trade flows, domestic investment, and future investment decisions by multinationals.
But yet, it has upgraded its forecast for Ireland's economy.
While overall they remain optimistic, there are concerns, but for now, it's too early to call.
Well, interesting times ahead, I'd say. Closer to home, has anything interesting caught your attention?
Well, much smaller in scale, but no less important because it affects another pillar of the Irish economy. I would mention a farming grant for inheritance tax advice.
You can't get any less international and more domestic than farmers. Well, who doesn't like some free advice? What does it cover?
There's a grant available for taking inheritance tax planning advice in relation to transferring farmland. The purpose of the grant is to encourage older farmers, those aged 60 and over, to go out and take inheritance tax advice.
How much are we talking exactly?
The grant covers up to 50% of the cost for legal and tax services, with a maximum payment of €1,500.
It's not a lot.
Josh, a lot of farmers leave basic wills and assume tax relief will be available. We end up meeting a lot of families looking to tax plan post-death due to unexpected problems.
That's true, and no doubt tax problems can be minimised or avoided with timely advice. Daphne, over to you. A listener emailed us about bank shares, and you had read something about this. What's the issue?
There was an interesting letter in the Irish Times from an AIB shareholder. They described their experience selling 13 AIB shares under the bank's recent buyback scheme. It caught my attention because it highlighted the challenges of calculating capital losses in a case like this.
How so?
Well, you have an accumulation of shares over many years, followed by dilution of shares and other adjustments. It just makes it very complicated.
Okay, but explain the AIB buyback scheme for those who are not familiar with it.
So, a couple of months ago, AIB launched the Odd Lot Share Offer, which was a buyback scheme, to simplify its shareholder base. It allowed small shareholders, particularly those with up to 1,000 shares, to sell them back to AIB at €3.90 per share.
Is this a big scheme?
Josh, AIB intends to cancel over 91 million shares. That's a lot of small shareholders.
Okay, asked and answered. What's driving this?
Well, it's about reducing administrative costs. Managing accounts with minimal holdings is expensive for companies. AIB would like to offload its smaller shareholders to save administrative costs.
And who exactly are these small shareholders?
Many were people left with tiny holdings due to AIB's 2015 share consolidation, which converted 250 of their old shares into one new share. Some shareholders were left with as few as 13 shares after the consolidation, making their positions too small to trade economically.
So, this sounds like a win-win?
Exactly. It gave shareholders with odd lot holdings a chance to exit without high transaction costs.
Okay, tell me about the tax angle.
Well, that's where things become challenging.
Why so?
These small shareholders will have suffered significant capital losses, and as the letter writer queries, they will want to calculate their tax loss for claiming against other gains.
I understand. Many of these will have acquired shares over many years and will have seen their shareholdings reduced during the 2015 share consolidation. Where should this shareholder, or anyone in a similar situation, begin?
You're right. They need to calculate the acquisition cost of each batch of shares they purchased or received as scrip dividends. This includes tracing back to the market value of the shares when they were issued. They must account for the 2015 share consolidation, which converted 250 old shares into one new share.
That sounds like a lot of math and paperwork.
It is, unless the person has kept meticulous records.
And if not, without them, what happens?
Without them, calculating an accurate capital loss or gain becomes nearly impossible.
So if a shareholder has limited or no records?
Well, a person could start by contacting brokers or the company's share register to obtain transaction information. Alternatively, shareholders could attempt recreating their share history using dates of acquisition and share price information from public sources such as the Irish Times.
What if all else fails? No records and no help from brokers?
While the article suggests that having the related paperwork is a must, revenue tend to be pragmatic. So as long as the taxpayer shows due diligence and justifies their estimates with reasonable effort, they may still claim the relief.
That seems like a nice, helpful note to end on. Having records is best, but it's not the end of the world without them.
Tax is a mixture of theory and practice. While good records make life easier, practical solutions exist for those who've lost them.
Right, that's great to know. Moving on, can we now talk about the story that really interests me? Here's the outline. A restaurant has amassed over €750,000 in unpaid taxes, lost its liquor license, and, to top it off, was trading insolvently. But the detail grabbing everyone's attention. Revenue officials investigating the case reportedly sampled premium wines and spirits during their sting. Daphne, what do you make of it?
Josh, this story is both serious and surreal. The unpaid taxes and illegal alcohol sales are one thing, but it's the extravagant taste of the revenue inspectors that has caught the imagination. The inspectors needed to gather evidence of unlawful alcohol sales, but instead of ordering a glass of beer, they opted for Tempranillo and Sailor Jerry spiced rum.
Let's be fair to the restaurant for a moment. Running a business, particularly in hospitality, is no easy feat. Alcohol sales made up 35% of their turnover. Losing their license must have been devastating. How does a business even recover from that?
It's incredibly challenging. Losing such a significant revenue stream can send any business into a downward spiral. Add to that likely over-leverage, poor financial management, and apparent misuse of collected taxes to fund day-to-day operations, and the situation becomes untenable.
It sounds like the directors made some poor choices.
They did, but they must have been under immense pressure. We all have clients who occasionally struggle, and the best thing to do is to engage with revenue, but through a tax expert.
Fair point. But dipping into collected taxes like VAT and PAYE, that's a line you just cannot cross, is it?
Absolutely, Josh. Those funds are not the businesses to use. But I've seen many cases where struggling businesses, desperate to stay afloat, treat those funds as a short-term loan. It's a bad decision, but often it's made out of sheer desperation rather than malice. But with the right advice, this could have been avoided entirely.
Speaking of consequences, the revenues affidavit didn't pull any punches. They stated the restaurant was trading insolvently for years. What could this mean for the directors?
It's very serious. Directors have a legal obligation to act responsibly when a company is insolvent. Ignoring this can lead to personal liability for the company's debts, especially if they knowingly allowed it to continue trading.
But let's address the optics here. I get that officials need to pose as customers during stings, but ordering Tempranillo and spiced rum is taking the biscuit. I'm sure that when revenue finally revealed the ruse, the owner was thinking, of all the gin joints in all the towns, they stepped into mine. Anyway, what's done is done. I'm sure you've come across distressed businesses before. What's the key to getting out of trouble in a business like this?
It's about damage control. I'd work with revenue to set up a repayment plan and provide a transparent account of the business's finances.
You still feel that there were opportunities to retrieve the situation?
There absolutely were, Josh. The restaurant's problem started more than 3 years ago. A lot of businesses have taxes outstanding back to COVID times. With the right advice at the right time, they can manage their debts.
Right, let's leave it there. Thank you both for those valuable tax updates. After the break, we'll shift our focus to the taxation of property and short-term lettings, a topic that's more relevant than ever. See you back here shortly.
Running a business means making big decisions, and when it comes to taxes, those decisions can have a lasting impact. Whether you're navigating complex property transactions, planning a corporate restructuring, or optimizing shareholder remuneration, you need a strategy that works for you. At CoVenture Tax Consulting, we specialize in tax planning solutions tailored for businesses. Our team of experts helps you tackle the complexities of property deals, corporate reorganizations, and shareholder planning, all while ensuring you stay compliant and maximize your financial outcomes. From strategic tax advice for growing companies to planning shareholder distributions and optimizing remuneration structures, CoVenture Tax Consulting provides clear, actionable solutions designed to save you time, reduce risk, and protect your bottom line. Your business deserves more than a one-size-fits-all approach. Partner with CoVenture Tax Consulting and unlock tax strategies that align with your goals. Visit coventure.ie, your trusted partner in smarter business tax planning, to schedule a consultation.
Now it's time to turn our attention to something that should be simple, but in reality is anything but the taxation of income derived from property. On the surface, it seems straightforward. You own a property, rent it out, and pay tax. But much like a building itself, what looks simple from the outside quickly becomes a maze of legacy rules, case law, and technicalities once you step inside. And just as understanding a property's value means knowing its history, the same applies to tax, because the treatment of a transaction today will be shaped by decisions made years, if not decades ago. So let's break it down and explore why property taxation is anything but a one-size-fits-all issue. Derek, where should we start on this topical journey?
Well, Josh, this topic may seem historical, but it's very relevant to the challenges taxpayers face today. A long time ago, the tax system was divided into schedules. For today's conversation, we have Schedule A and Schedule D.
And how did these schedules differ?
Schedule A was designed to tax income derived from property ownership. It was an obligatory charge based on the property's value, not the profits generated. Schedule A reflected a world where wealth was tied to land ownership, which was seen as stable and enduring. On the other hand, Schedule D taxed income from business, trade, and professions. Schedule D emerged alongside industrialization, recognizing the entrepreneurial middle class generating income through trade and services.
So Schedule A, basically a wealth tax on owning stuff, and Schedule D, a tax on effort. There are very obvious hallmarks of early feudal tax systems which continued into industrialized times. Laws which ensured that peasants and merchants bore most of the tax burden, while aristocrats enjoyed exemptions and privileges. This pattern continued into industrial-era taxation, where emerging business owners faced heavy taxation, while inherited wealth and land ownership remained lightly taxed or exempt.
Schedule A was deeply tied to the landed gentry and aristocracy. It taxed income from property ownership, which was the primary source of wealth for the upper classes. Meanwhile, Schedule D reflected the rise of the entrepreneurial middle class during the Industrial Revolution, where wealth came from business and commerce rather than from land.
Early tax laws were very different then. In effect, structured to cushion the gentrified and squeeze the lower and middle classes.
Landowners under Schedule A were taxed on the property's value rather than the actual profits. Conversely, those taxed under Schedule D faced assessments based on real business earnings, which fluctuated.
So here we are, in an era where the tax system rolls out the red carpet for the wealthy. How were the new rich treated? Were there any legal challenges from those trying to join the inner tax circle?
Yes, and the case law is fascinating. A seminal case is Salisbury House Estates Limited. This case is almost 100 years old, but has a very modern feel. In fact, you wouldn't be surprised to read about it in next week's Financial Times. It concerned over 300 office suites located within a single building in London. These suites were let as serviced offices, with additional services such as cleaning and heating provided. The House of Lords was asked to consider if income from serviced offices should be taxed under Schedule A or Schedule D.
Interesting. Someone wants a seat at the big boys' table. What happened?
The House of Lords ruled that the activity was to be taxed under Schedule A rules.
What am I missing? What was the big deal about this case?
Income from all the other services being provided couldn't be taxed at all.
Get on that groovy train. Did this case have an impact in Ireland?
The same principle appeared in Birch v Delaney, where the Supreme Court ruled that a builder's income fell under Schedule A, despite it clearly being a trading activity. The court ruled that the income fell under Schedule A because of the preeminence of its application to property-related income at the time, even though the activity had all the characteristics of a trade.
Wait, a building activity has all the characteristics of a trade? You mean he wasn't taxed on his profits? What a sham!
The builder was clearly delighted with the outcome of that case.
So the doors were opened for the new rich to access the asset-friendly tax rules. What happened next?
In 1921, the House of Lords ruled differently in another case, Coleman versus Governors of the Rotunda Hospital. The Rotunda Hospital let out furnished rooms for events, and the court ruled that this was taxable under Schedule D because the activity resembled licensing rather than property income. But these cases were exceptions, not the rule.
So how is this history relevant to the taxation of property income today?
The historical distinction between property income and trade income still underpins modern tax rules. Even though Schedule A was abolished in 1969, its principles persist. For example, today's distinctions between passive rental income and active trading income echo the old Schedule A and Schedule D divide.
So what you're saying is, these cases are the reason there's so much grey area when it comes to taxing certain types of property income, like short-term lets?
Absolutely. Modern landlords often struggle with these classifications. Are they simply earning rental income, or are they running a business? The tension between passive and active income, rooted in this history, continues to complicate things up to today.
Well, your average Airbnb host isn't sitting around reading tax law. What's the main takeaway? What should they know before the revenue commissioners come knocking?
The main takeaway is the importance of understanding your activity's nature.
For example,
if your income is from passive property ownership, it might resemble the old Schedule A, but if you're actively involved, managing bookings, providing services, You're closer to the entrepreneurial model, which historically was taxed under Schedule D.
So, let's bring things up to date and make this conversation relevant. Schedule A no longer exists as a classification, but the legal principles for distinguishing income continues. Where does the law stand today?
Today, almost all income, but not including employment income, is taxed under Schedule D. The modern Schedule D, however, has multiple subcases for different types of income stream. I find it helpful to think of these like cases in a hospital. On the first ward, we put all the high energy cases. We call them the Case 1 types. These cases are constantly monitored as they're actively generating income. On the fifth ward, we put the long-term patients, and we call them Case 5 types. These are just lying there, not doing very much, but still accumulating wealth even while half asleep. We also have a fourth ward, by the way, for patients with unexplained symptoms, and we refer to those as Case 4 types, but they're not relevant to this conversation.
And how do you decide where to place new patients? How do you figure out if they're Case 1 or Case 5 types?
So when a new patient arrives, we have to decide, are they high energy, active Case 1 types, or passive Case 5 types? The decision comes down to how much effort they're putting into generating income. Are they up and moving about, or just lying there letting the money roll in?
Right, I think the hospital analogy has run its course. Daphne, let me bring you in here. Why does it matter which case my property income is taxed under?
Good question, Josh. It matters today because these classifications carry different tax rates and rules. For example, income from trade, which falls under Case 1, is taxed at the lower corporate rate of 12.5%, but rental income, under Case 5, is hit with 25%, plus restrictions on deductions.
So the stakes are high. Classifying property income under Case 1 or Case 5 will amount to a significant difference in the rate of tax and how profit is calculated. And the line between renting and running a business is blurry.
If you're just letting a property long-term, that's straightforward rental income. But if you're providing short-term stays with additional services, think cleaning, managing bookings, or even breakfast, you might cross into trading income territory.
And how is someone to know where is the line between trading and pure rental?
The law still isn't clear on where the line is.
Right, well, let's then consider some modern business practices. We already touched on a topical area, short-term lettings such as Airbnb lets. This is one area where things get spicy. Tell me about how the tax rules impact a small operator, someone renting out a property long-term, for example.
The classifications don't have a material impact for someone renting a property out long-term. That person is taxed at his or her marginal rate and is entitled to deductions for advertising, cleaning, repairs, etc.
What about a person who offers short-term stays and operates on platforms such as Airbnb?
Airbnb changed the game, Josh. It blurred the traditional boundaries of landlord and tenant relationships. Instead of year-long leases, you now have overnight stays. Revenue initially treated this as rent, but with all the added services involved, like online booking systems and on-demand flexibility, they've started saying, wait a second, this looks like a business. That shift has caused confusion for hosts, trying to figure out if they're landlords or entrepreneurs or both.
So should a person with a property on Airbnb be concerned about how their income is classified?
For an individual carrying on an Airbnb activity, the classification won't have a huge impact, although there is VAT to consider. Where property is held within a company, the position is very different. This is because the activity may be taxed at either 12.5% or 40%, depending on whether it's regarded as a trade or investment.
And what about bigger operators? How are they taxed?
To understand how larger operators are taxed today, be they individuals, partnerships or companies, we have to consider modern High Court rulings.
So what's the High Court been up to?
A recent case involved a partnership renting out 26 self-contained units, and the court had to decide, is this just rent or is it a business?
What was this case about?
For context, it all started because Revenue wanted to tax the income under Case 5, rental income, which meant higher tax rates and fewer deductions. But the taxpayer argued that what they were doing was a trade, meaning lower tax under Case 1. The High Court had to figure out what exactly was going on.
How did the High Court approach the case?
They looked at the entire setup. Each unit was fully furnished, the partnership provided cleaning services, and bookings were short-term. Think tourists, business travellers and students. The partnership managed the whole operation from maintenance to guest interactions. Revenue said, this is just property income. But the partnership said, no, this is a proper business. And the High Court agreed with the taxpayer.
What tipped the scales in the taxpayer's favour? Was it the fact that it wasn't just a set-it-and-forget-it rental operation?
Exactly. The court focused on the active management aspect. It wasn't just about collecting rent and leaving tenants to their own devices. They ran it like a hotel, services, maintenance, and even responding to guest needs. The court decided this level of engagement turned it into a trade. But the case also highlighted something important. It's not enough to claim you're running a trade. You have to prove it. They looked at whether the activity had a profit motive, was managed on a commercial basis, and involved frequency and consistency. If you tick those boxes, you're likely running a trade.
Fascinating. So this sounds like an important case with implications for anyone involved in short-term lettings. How has the case impacted the tax landscape?
It's been a key reference point, especially for taxpayers trying to argue that their short-term rental should qualify as trading income. But there's still uncertainty because courts assess each case individually. If you're running a one-off Airbnb with minimal services, you probably won't meet the threshold for trade. But if you're managing multiple properties with active involvement, you're more likely to qualify.
What's Revenue's approach for less clear-cut cases?
Revenue might argue for the higher tax rate, and that's still a grey area.
If someone is listening to this podcast, they might ask, what do I need to know if hosting on Airbnb or another platform?
They need to understand how Revenue might view their activity. If you're letting out a spare room with minimal involvement, no cleaning between guests, no extras like meals, that's probably rental income under Case 5. But the more effort you put into it, the more you venture into trade territory.
What about someone with, say, a holiday home?
If you're running a holiday home where you're handling bookings, offering cleaning, and maybe even providing welcome baskets or local recommendations, you're behaving more like a small hospitality business. That's where the lines start to blur, and Revenue could argue it's trade income.
For properties held in companies, there is a big incentive to adopt trading treatment to access the 12.5% rate of tax. What are the risks with this approach?
Well, if you classify your income incorrectly and Revenue audits you, you face back taxes, penalties and interest. That's a financial nightmare for small hosts. But it's not just about money, it's the stress and time spent untangling these issues.
What advice do you have for larger operators where you may have multiple units in the same or different buildings, quite a lot of activities, etc.?
In the larger cases, hosts need to document everything. How many guests they're hosting, the services they're providing, the expenses they're claiming, all of it needs to paint a clear picture. Larger operations will typically have staff on payroll, third-party services such as cleaning, and will have a finance function. It's vital to keep adequate detailed records and to document the running of the business. As we learned in the last podcast, having records to defend your activity is vital.
Okay, thanks Daphne and Derek. That seems like a good place to stop. We've covered the history of property tax law, the modern classifications that apply, Case 1 and Case 5. We've discussed some key tax cases which laid the foundation for claiming trading treatment on certain property activities. And we've discussed some specific use cases. In our next episode, we'll discuss recent cases where taxpayers have run into difficulties. We're going to discuss the VAT and estate planning implications of claiming trading treatment and more. And with that, we've concluded another episode of Irish Tax Unwrapped. Until next time, keep your finances in check and your tax knowledge sharp.
If you enjoy Irish Tax Unwrapped, please rate, subscribe and share the podcast. If you've any questions or topics you'd like us to cover, please contact the show on X @TaxUnwrapped or email the show podcast@taxiq.ie.